Hey guys, how are you doing out there? This is Vijay Bambani here. Welcome to our first free video edition of the Morts Musings newsletter. First of all, I'd like to begin by thanking you for making this weekend free newsletter so very popular in the last 15 months that I've started sending it out. And on your request, we are now taking it to video format. What's new in this video format? For the first time, we are going to discuss a couple of stock leads. So far, we've focused on the indices, BankNifty and the Nifty. We focused on bond markets. We've talked about the Dixie a little bit and general directions. Now, I'm including a couple of stock leads. I'm also going to present you with a little more in terms of data, in terms of graphics, and also trying to share the way I think so that we can basically get to know how each of us thinks and how professional traders in the market look at various parameters to gauge the direction of the market. Also remember, this is a free newsletter in video or in text, whatever it may be, and it is always likely to remain free. So feel free to share it with your friends, with your family, and sit back, enjoy the ride. So first of all, I'd like to begin by talking about the market roundup. How did the markets really pan out? What really happened in the markets? And what to expect in the week ahead. First of all, the Nifty in the spot segment gained 3.32% on a week-on-week basis. The BankNifty spot gained 6.88% on a week-on-week basis. Now, obviously, the BankNifty outperformed the Nifty 50 for a simple reason that there was a stimulus expectation. There were announcements to be made on the banking space where interest upon interest was concerned, which was actually announced over the weekend. So the action was on the BankNifty in relative terms. On the MCX, gold gained 1.85%. On the same exchange, silver gained 3.59%. Silver happens to have a little more volatility than gold and it therefore outperformed. Crude oil fell 4.45% on a week-on-week basis, even though the closing I've taken is of Thursday because Friday our markets were closed here. And natural gas on the MCX fell 12.76% on a week-on-week basis. Now, these are two things, crude oil and natural gas, which you will have to keep in mind in the coming week because these are inflation triggering commodities and their price coming down is good because crude oil and natural gas are what I call multiplier commodities. If crude oil and natural gas prices go up, fuel prices go up, immediately your fruits, vegetables, wheats, grains, etc. all become milk, eggs, all become more expensive. So falling crude and natural gas prices are a positive for the week ahead. On the other hand, the 10-year bond yields fell by 0.66% to 5.98%. Now this basically tells you that there was buying in the bond market, and even though it might be good for the bond portfolios of banks, it's not really very good news because more bond buying would typically indicate to me that there is a flight to safety. The market-wide position limit across the NSE futures segment rose to 30.02%. On a week-on-week basis, this represents 15.55%. Now, those of you who follow me on social media would know that I put up these figures every evening after market hours, Monday to Friday. And MWPL basically to me represents or indicates the trader interest and participation in the market. So if MWPL is rising, it means traders have greater expectations from the markets, and to that extent, they will build up positions. Now, that can also be borne out from some of the data that I'm going to share with you in the next couple of minutes. Now, let's take a look at the volumes. Volumes, we first begin with the indices. And I've clubbed the BankNifty and the Nifty volumes in the futures together they happen to be at the lowest after 28th of September, as you could basically see on your screen. And where stock futures volumes are concerned, they were even lower. Now that's the lowest after 8th of September 2020, as you would have seen on your screen. Now, this is not exactly confidence inspiring. If the traders were really all that gung-ho, the volume should have actually gone up. But part of the reason could also be that we had a very long weekend. Friday was a holiday in India due to Gandhi Jayanti, and an extended weekend also brings along with it a sense of uncertainty. So part of that I'm willing to discount. But on the whole, I have seen volumes go down as the markets reach higher and higher levels. So at higher levels, bullish conviction is basically tapering off a little bit. Now, where the open interest is concerned, now this gets interesting. Where the open interest is concerned, the Nifty open interest in the prompt month futures is at its highest after 18th of September 2020. And traders are typically preferring to hold on to their positions which they initiate, which means a high degree of expectation and a high degree of kind of ambition in the market about digging your heels into the market and not surrendering your positions. So that will have a bearing on the volatility in the market in the coming week. Where the BankNifty open interest is concerned, it was the highest after 23rd of September 2020. Now, relatively speaking, the BankNifty has been more volatile, which is why the open interest on the BankNifty tends to be somewhat at its recent highs as compared to the Nifty 50, where the activity is a lot more relaxed. As you will be seeing on your screen, the MWPL has risen rapidly post expiry. Now, this is something that I have seen in the August futures as well as in September futures series, that the MWPL is rising extremely fast. MWPL stands for market-wide position limits. Now, across the board, traders are ramping up positions on an aggregate basis to the upper end of the historical band, the band that we've seen every derivative settlement. They're taking open market-wide position limits or open interest to the upper end of the band in the second week of the derivative cycle itself. Typically earlier it used to be in the third week, which means positions are getting ramped up faster and higher. This is expectation rising in the market, which, like I said, will probably lead to higher volatility, because expectations belied will also result in a flurry of unwinding. That makes the market more vulnerable to higher beta or higher volatility. Now, as you would see, the basis chart. Now, this is again something that I put up on my social media accounts every day, and I swear by the indications of the basis, which is the difference between the futures and the spot market. There's a huge spike up in the basis of both the indices, which is because the bears were basically forced to cover their short positions due to the extreme amount of rally in the markets. And once they cut their shorts in a panic, the premium in the futures simply expanded. That basically tells you that the market was kind of one-sided on the last trading session of the week, which was Thursday. The USD INR has reached its lowest in 19 trading sessions, which is the 4th of September. Now, this is again a positive for the markets, because falling dollar means cheaper imports, and 2/3 of our imports happen to be fossil fuels, which is crude oil and natural gas. Like I told you earlier, fossil fuels are multiplier commodities, and higher fuel prices would mean higher inflation and fruits, vegetables, milk, eggs, etc., etc. So a strong rupee has basically been the plus point of the previous week, and should it continue, it will work to the advantage of the bulls here. Now, we come to the dollar index. Why is it important? Because the dollar index basically determines the USD INR. It may not be in 100% lockstep fashion, but definitely a very dependable correlation exists between the Dixie, which is the dollar index, and the USD INR. And like I just said, higher the USD INR, the more pressure on Indian markets due to imported inflation, which is when you import something, it becomes more expensive because your rupee is cheaper against the dollar. So the Dixie is important to me because I see a negative correlation between the Dixie and the Indian markets. If the Dixie is high, our markets fall, and vice versa. So this Dixie is the benchmark of the US dollar versus the global basket of currencies. It ended the week with 0.84% losses. It fell on 4 out of 5 sessions last week, but it still managed to close above its 25-day exponential moving average, which I'm sure you're seeing on the charts in front of you on your screen. And the 25-day exponential moving average is currently poised at the 93.66 mark. If at all the Dixie trades sustainably below this level, I fear it could trigger off more weakness in the US dollar. And the election cycle itself means that the US administration will want a stronger dollar and a stronger Dixie. It's basically this time the US elections are marred by a lot of volatility, as you would have no doubt observed from the news about the incumbent President Donald Trump being infected with corona, and the US markets basically going into a sense of frenzy. So which is why a lot of emerging markets, including India, have been spared a lot of declines because the Dixie has not really risen as much as it has in the run-up to the elections as we have seen in the past. This phenomena is actually called the US presidential election cycle. Once in 4 years, you will see a lot of feel-good factor and positivity come into the US markets. Rising dollar, rising real estate prices, rising stock markets, falling gold and silver, and falling crude oil and natural gas prices to curtail inflation. But this time around, things are a little out of hand, which is why the emerging markets are being saved a lot of blushes. Now, the range which I had advocated last week between 96.40 on the upper end and 93.20 on the lower end held, which basically leads me to believe that in the coming week, you're likely to see the Dixie hit 95.30 levels in case of upsides and 92.30 in case of declines. In terms of which days to watch out for while observing the Dixie, I think all 5 trading sessions of the week has data pertaining to the US economy and US specific data being released, which is keeping the Dixie traders on their toes almost all week long. So you're unlikely to be spared any kind of respite from watching your screens. Now let's turn to the bond markets. Normally I begin the Morts Musings newsletter looking at the bonds, and this time around I'm taking it second place. What was the high point of the bond market was that the 10-year benchmark yield, like I mentioned, has fallen below the 6% threshold. The RBI was supposed to have a monetary policy committee, the MPC, meeting to determine Indian interest rates, which was called off. Now, this basically led to a flurry of buying in the bond markets, and bond prices went up, which is why your yields are down, as you are seeing on your screen. And the bond markets basically give me a lot of indications about the money supply, the interest rates, and the expectations from the monetary policy. Whereas low yields might be good for bond prices and therefore mark-to-market profits for bond portfolios of banks, it basically also tells me that there is a flight to safety and flight to safe haven buying in bonds, which means that markets are getting to be in a risk-off mode. I'm sorry. So banking stocks in the coming week might just be a little more volatile than usual because bond yields are now below 6%, and lower yields also means that investors in fixed income securities, fixed deposits, public provident fund, and other corporate and private bonds, etc., are likely to have a compression in fixed income from their sources, and they might be compelled to take higher risk gambits in the market. And unfortunately, some of them or many of them may not really know the real risk reward payoff on the Jensen's measure. Last weekend, I wrote in the Morts Musings newsletter to you, which was in the PDF format, that the Jensen's measure for the fourth week in a row does not indicate a good risk reward ratio for the bulls, which means if you're willing to take one additional unit of risk, you're unlikely to make one additional unit of reward, which is profit. Ideally, the reward should be much higher than the additional risk that you are taking. So on the next one is the BankNifty. We'll now turn to the BankNifty, and this index rose on 3 out of 4 sessions last week, clocking 6.88% gains, and in relative terms, it outperformed even the Nifty 50. It's managed to close above its 25-period exponential moving average on Thursday, where the immediate reaction was expected to be. And last week, I advocated a range between 23,000 to 19,000, which basically held. And immediate resistance may be seen at the 22,757, which was the intraday high of 14th of September 2020. And should this level be overcome forcefully on a sustained closing basis, I would not rule out the possibility. Remember, we are talking possibilities here, not guarantees. I would not rule out the possibility of 24,000 being scaled on the BankNifty. However, in case the 25-period moving average is violated on the downside and the BankNifty turns negative due to whatever news flow or whatever reasons intra-week, I think the support of 20,750 needs watching. And should this level be violated, this was basically be a watershed moment for the bulls, because you can then expect more declines from this level. BankNifty is entering a very decisive phase as far as I'm concerned, because it's rising with extreme increase in its volatility. The index is actually ranking number 4 on the NSE in terms of statistical beta. Statistical beta is basically volatility, pure price-based volatility. Now, an index being number 4 on the statistical beta reading itself tells you that traders are likely to find it a challenge. You can suddenly expect wild and large price moves in either direction, which means you need to exercise greater caution. And the expectations on this index have also risen, which is why I mentioned that the open interest in both the indices has gone up. And the days that you need to watch out for are the 6th of October, 7th October, and 9th October, because there is announcement of India-specific news in the coming week, which will directly impact the BankNifty. And on these days, I would suggest you trade lighter, because the data may or may not be really in the direction that you take a trade, which means you are susceptible or vulnerable to some surprises on the negative side. Let's now get down to the Nifty 50. The most liquid, the most well-traded, low-impact cost counter on the National Stock Exchange. Basically, for traders who wish to get in and get out easily in large quantities, the Nifty has no comparison. Now, the Nifty has been outperforming the benchmark Bank Nifty by a wide margin. It's recovered more losses as compared to the Bank Nifty from the lows of March 2020. It's been basically giving returns head and shoulders above the Bank Nifty, and that outperformance seems to be continuing. Now, the index last week gained 3.32% on a week-on-week basis, and it gained on 3 out of 4 trading sessions last week, which basically is a commendable thing, and it tells you that the bulls retained their grip on the index. And the Nifty 50 is back above its 25-day period exponential moving average, which is poised at 11,291. As long as the bulls manage to keep the Nifty above the 11,291 levels, all is well, and the upthrust might just extend. The previous significant high was 11,618, which was made on 16th of September 2020, which will be the near-term, immediate but weak resistance that the bulls might encounter. If at all it's taken out very forcefully with high volumes, with conviction, and unhesitatingly closing above this threshold, the upside potential opens up to 11,875 levels. On the flip side, if the bulls are not able to retain the Nifty above the 11,291 level, which is the 25-day period exponential moving average, do not rule out the possibility of a decline to 10,900 levels approximately. Now that basically will require some kind of surprise negative news or a sharp sell-off to trigger. The Nifty, by the way, happens to be number 9 on the most volatile list on the NSE as compared to number 4 of the Bank Nifty, and therefore it provides less of high blood pressure or stress onto a trader in relative terms as compared to the Bank Nifty. The statistical beta on the Nifty rose 91.54% in the last 10 trading sessions, which means it almost doubled in volatility. Now that itself should tell you that challenges at higher levels are mounting. Choppiness, volatility, your stop losses hitting first and your targets coming later, all that is occurring because of this single phenomena itself. Now, last week I advocated a range of 11,500 on the upside and 10,450 on the downside, which held. The lipstick rally which I had anticipated is still ongoing, and the days to watch for Nifty traders will be 6th, 7th, 8th and 9th October due to India-specific news triggers. The period of high volatility is likely to persist because these news triggers will impact volatility based on traders' anticipations. They'll try to second guess what the news is likely to be. If the news is against their expectations, of which half the side of the market is going to be against taking contra positions, there will be a lot of give and take, a squaring up of positions. So I do expect volatility in the coming week to remain elevated. To that extent, traders in the Nifty and the Bank Nifty should be extra cautious. Now I come to the last segment of the Morts Musings newsletter and the new segment that we've added on, the stock leads. Now I've split the stock leads into 2 segments. One is high beta or high volatility, high impetus stocks, which you can buy in smaller or sell in smaller quantum, but wait for larger amplitude, which is the movement of the price. Now, I'm not telling you to buy or sell any stock. I'm just shortlisting the stocks, which will tell you that these are the counters that you need to focus on for trade in the coming 1 week. Now, 2 types of traders exist. Somebody who will buy 500 shares wait for 10 rupees and earn 5,000 bucks. The other is somebody who will buy 5,000 shares, wait for 1 rupee and earn 5,000 bucks. So which counter will favor which kind of trader? I'm about to tell you. The high beta and high impetus stocks, which you buy in smaller quantity but wait for larger price moves, are in their descending order of names. Number 1 comes BankNifty. It's very high in volatility. Number 2 comes Maruti. Number 3 comes Nifty 50. Number 4, Bajaj Finserv. And number 5, Bajaj Finance. You could basically take a trade in either direction depending on your trading terminal screen. If the screen is indicating bullishness, you will buy. If the screen is indicating bearishness, you will sell. So I'm not giving you the direction. I'm just pinpointing the counter. This is why I call it a stock lead rather than a stock recommendation. Now, for traders who resort to high frequency trading with larger quantity but on small price move, they flip the trade, ingress, egress, enter, exit very often. Those kind of counters have an advantage where the hit or miss or the risk and reward tend to be smaller. A trader gets in and gets out of the trade fairly more frequently to be able to earn that same 5,000 bucks in a day. But it's to be traded only on those counters where the volatility and the amplitude is low. Where everybody else says, oh, this stock doesn't really move much, it moves only $1 in a day or $2 in a day. The high frequency trader knows that he's weaving in and out of the stock 10 times a day, just like a pizza delivery boy goes in and out of the traffic, weaves in and out of the traffic, and very quietly goes and does his job. So these counters where beta is low and impetus is low are led by Bank of Baroda being on number 1, Tata Power being on number 2, number 3 being brought up by Federal Bank, number 4 ONGC, and the rear is being brought by Indian Oil Corporation or IOC. Now both these stocks, both these category of stocks require a different mindset, a different attitude and aptitude, but if you're a statistics or a systems-based trader, you know what I'm getting at. You know, basically in high impetus, take small exposure, play for bigger price, and low impetus, take bigger exposure and trade on buck or maybe even less. I hope you liked this presentation of the video format of Morts Musing. Depending on your feedback, because this endeavor on our part is for you, depending on your feedback, we may continue with this video format or revert back to the PDF file format as you like it. This is your newsletter. Let me know what you think. I'm eagerly awaiting your feedback. Feel free to click like on this video if you agree with what you saw. In the comment section, do let me know what you feel. Bricks, bouquets, positive, negative feedback, everything is welcome. I'll bid goodbye to you in this video till we meet again in my next. Have a very, very profitable week ahead. Vijay Bambwani signing off for now. Thank you for watching my video.